Hello everyone. Today we discuss about depreciation and ratio analysis in accounting for managers first semester MBA unit 2. So depreciation reduces the value of assets on a residual basis. It also reduces the profits of the current year. Depreciation indicates reductions in value of any fixed asset. Reduction in value of assets depends on the life of asset. Life of assets depends upon the uses of assets. There are many deciding factors that ascertain the life of assets. For example, in case of a building, the deciding factor is time. In case of leased assets, the deciding factor is the lease period. For plant and machinery, the deciding factor should be production as well as time. There can be many factors, but the real of assets should be ascertained on some reasonable basis. Provision for depreciation is essential to ascertain the true profit earned or true loss incurred by a business house during a year and to show a correct financial position in the balance sheet at the end of the year. Why do we need to account for depreciation? Needs to provide depreciation. To ascertain the true profit during a year, it is desirable to charge depreciation. To ascertain the true value of assets, depreciation should be charged. Without calculating the correct value of assets, we cannot ascertain the true financial position of a company. Instead of withdrawal of overstated profit, it is desirable to make provisions to buy a new assets to replace old asset. The accumulated value of depreciation provides additional working capital. Depreciation helps in ascertaining uniform profit in each accounting year. Depreciation allows to take the advantage of tax benefit also. Now the basic factors of depreciation. While calculating depreciation, there are certain basic factors which have to be taken into consideration. These factors now I describe in details. First, cost of asset. Depreciation has to be calculated on the basis of the cost of the asset to be depreciated. The cost includes the price paid for the asset, the amount spent on its acquisition, freight, octroi, and carriage and installation of the asset. Useful life of the asset. Number 2. Another factor that affects the amount of depreciation is the useful life of the asset. A machinery may be capable of running for 15 years, but if the firm is expected to replace it after 10 years due to obsolescence, the estimated useful life of the machine will be considered to be 10 years for the purpose of calculating depreciation. Now, number 3, scrap value. The scrap value of the asset at the end of the useful life of the asset, the estimated scrap value is deducted from the cost of the asset for calculating depreciation. If in a question the scrap value of the asset is not given, it should be assumed that it is nil. So much depreciation has to be provided as will reduce value of the asset to its scrap value at the end of its estimated life. Now, methods of depreciation. Depreciation can be calculated using any of the methods, that is straight line method, written down value method, unity method, insurance policy method, machine hour rate method, depletions method, revaluation method, depreciation fund method, straight line method. It is called fixed percentage on original cost method or fixed installment method. Under this method, a suitable percentage of the original cost is written off the asset annually. Thus, if an asset cost is rupees 1 lakh and the depreciation rate is 10% per annum, then the amount of the depreciation is 10,000 will be provided every year if scrap value of the asset at the end of its estimate life of 10 years is considered to be nil. To ascertain annual depreciation, the formula is depreciation equal to cost of assets minus scrap value of assets divided by estimated life of asset. Now, straight line method. 1/3 of the machinery which was purchased on become obsolete and was sold for 60 or 6,000. Now, diminishing balance method. According to the diminishing balance method, depreciation is charged at a fixed percentage on the book value of the asset. As the book value reduces every year, it is also known as the reducing balance method or written down value method. Since the book value reduces every year, hence the amount of depreciation also reduces every year. Now, the annuity method. This method of depreciation considered the cost of the asset and also the amount of interest lost on the capital expenditure. Thus, it is based on the assumption that if the amount that is spent on the purchase of the asset was invested elsewhere, it would have earned a certain amount of interest. Therefore, not only the cost of the asset should be allocated, but also the amount of interest on it should be allocated over the useful life of the asset. In other words, this method determines the internal rate of return, that is IRR, on the cash flows of the asset. Thus, amount of depreciation is calculated using the annuity tables, the capital expenditure and interest accruing thereof are written off during the life of the asset. The amount of depreciation every year is constant, but the interest charged in the initial years is more than that in later years is less. Hence, the amount of capital expenditure charged is less in the initial years and it is more in later years. This method is suitable in case of long-term lease. On the contrary, it is not suitable where there are frequent additions or deductions in the asset, because then the calculation of depreciation becomes difficult. Now, ratio analysis. Ratio is an arithmetical expression of a relationship between two numbers. Similarly, in finance, ratios are a correlations between two numbers, or rather two accounts. So two numbers derived from the financial statement are compared to give us more clear understanding of them. This is an accounting ratio. Ratio analysis is used to evaluate a number of issues with an entity, such as its liquidity, efficiency of operations, and profitability. This type of analysis is particularly useful to analysts outside of a business, since their primary source of information about an organization is its financial statements. Ratio analysis is less useful to corporate insiders who have better access to more detailed operational information about the organization. Now, ratio analysis is particularly useful when used in the following two ways. Trend line: calculate each ratio over a large number of reporting period to see if there is a trend in calculated information. The trend can indicate financial difficulties that would not otherwise be apparent if ratios were being examined for a single period. Trend lines can also be used to estimate the direction of future ratio performance. Industry comparison: calculate the same ratios for competitors in the same industry and compare the results across all of the companies reviewed. Since these businesses likely operate with similar fixed asset investments and have similar capital structures, the results of a ratio analysis should be similar. If this is not the case, it can indicate a potential issue. Or the reverse: the ability of a business to generate a profit that is notably higher than the rest of the industry. The industry comparison approach is used for sector analysis to determine which businesses within an industry are the most and least valuable. Now, objectives of ratio analysis: interpreting the financial statements and other financial data is essential for all stakeholders of an entity. Ratio analysis hence becomes a vital tool for financial analysis and financial management. Let us take a look at some objectives that ratio analysis fulfills. Number one, measure of profitability. Profit is the ultimate aim of every organization. Gross profit ratios, net profit ratio, expense ratio, etc. provides a measure of the profitability of a firm. The management can use such ratios to find out problem areas and improve upon them. Number two, evaluation of operational efficiency. Certain ratios highlights the degree of efficiency of a company in the management of its assets and other resources. It is important that assets and financial resources be allocated and useful or used efficiently to avoid unnecessary expenses. Turnover ratio and efficiency ratios will point out any mismanagement of assets. Number three, ensure suitable liquidity or liquidity. Every firm has to ensure that some of its assets are liquid in case of requires cash immediately. So the liquidity of a firm is measured by ratios such as current ratio and quick ratio. These help a firm maintain the required level of short-term solvency. Number four, overall financial strength. There are some ratios that help determine the firm's long-term solvency. They help determine if there is a strain on the assets of a firm or if the firm is over leverage, the management will need to quickly rectify the situation to avoid liquidation in the future. Examples of such ratios are debt equity ratio, leverage ratios, etc. Number 5, comparison. The organization's ratios must be compared to the industry standards to get a better understanding of its financial health and fiscal position. The management can take correct action if the standards of the market are not met by the company. The ratios can also be compared to the previous year's ratios to see the progress of the company. This is known as trend analysis. Now, advantages of ratio analysis. Ratios are essentially whistleblowers. They draw the management's attention toward issues needing attentions. And ratio the it simplifies complex accountability system and financial data into simple ratio of operating efficiency, financial efficiency, solvency, long-term positions. Ratio analysis help identify problem areas and bring the attention of the management to such areas. Some of the information is lost in the complex accounting statements, and ratios will help pinpoint such problems. Allows the company to conduct comparisons with other firms, industry standards, intra-firm comparisons, etc. This will help the organization better understand its fiscal position in the economy. Now, limitation of ratio analysis. Limitations of ratio analysis. While ratio are very important tools of financial analysis, they have some limitations, such as the firm can make some year-ended changes to their financial statements to improve their ratio. Then the ratio end up being nothing but window dressing. Ratios ignore the price level changes due to inflations. Many ratios are calculated using historical cost and they overlook the changes in price level between the period. This does not reflect the correct financial situation. According ratios completely ignore the qualitative aspects of the firm. They only take into considerations the monetary aspects and quantitative. There are no standard definitions of the ratio, so firms may be using different formulas for the ratio. One such example is current ratio, where some firm take into consideration all current liabilities but other ignore bank overdrafts from current liabilities while calculating current ratio. And finally, accounting ratios do not resolve any financial problems of the company. They are a mean to the end, not the actual solutions. Now, types of ratios. The types of ratios according to the functional classifications are liquidity ratio, leverage ratio, activity ratio, profitability ratio, coverage ratio. Liquidity ratio, a firm needs to keep some level of liquidity so stakeholders can be paid when they are due. All assets of the firm cannot be tied up. A firm must look after its short-term liquidity. These ratios help determine such liquidity so the firm may rectify any problems. The two main liquidity ratios are current ratios and quick ratio or liquid ratio. Now, leverage ratios. These ratios determines the company's ability to pay off its long-term debts. So, they show the relationship between the owner's funds and the debts of the company. They actually show the long-term solvency of a firm, whether it has enough asset to pay off its stakeholders, as well as all debts on the balance sheet. This is why they are also called solvency ratio. For examples are debt ratio, debt equity ratio, capital gearing ratio, etc. Now, activity ratio. Activity ratios help measures the efficiency of the organization. They help quantify the effectiveness of the utilizations of the resources that a company has. They show the relationship between sales and assets of the company. These type of ratios are alternatively known as performance ratios or turnover ratios. Some ratios like stock turnover, debtors turnover, stock to working capital ratio, etc. measures the performance of a company. Profitability ratio. These ratios analyze the profits earned by an entity. They compare the profits to revenue or funds employed or asset of an entity. These ratios reflect on the entity's ability to earn reasonable return with respect to the capital employed. They even check the soundness of the investment policies and decisions. Examples will include operating profit ratio, gross profit ratio, return on equity ratio, etc. Now, coverage ratio shows the equations between profit in hand and the claims of the outside stakeholders. These are stakeholders that are required by the law to be paid, even in case of liquidations. So these type of ratios ensures that there is enough to cover these payments to such outsiders. Some examples of coverage ratios are dividend payout ratio, debt service ratio, etc. And the liquidity ratio. A firm has assets and liabilities to its name. Some are fixed in nature, and then there are current assets and current liabilities also. These are short term in nature and easily convertible into cash. And the liquidity ratios deal with the relationship between such current assets and current liabilities. Liquidity ratio evaluates the firm's ability to pay its short-term liabilities, that is current liabilities. It shows the liquidity levels, that is how many of their assets can be quickly converted to cash to pay off their obligations when they become due. It is not only a measure of how much cash there is, but also how easily current assets can be converted to cash or marketable securities. So that's the end of the video, my friends. If you like my blogs, please subscribe my channel and also share my channel. Thanks again for watching my video.